In this chapter, we're going to have a look at our final financial statement that we need to prepare for limited liability companies. And that's known as the statement of cash flow. So we're going to spend several videos having a look at the statement of cash flow and looking at how we prepare one from start to finish. Now again, it's really important to remember that you've got to see the bigger picture of F3, being able to do things from scratch and in full before you can do little bits. And that's truer than ever with cash flows. You will not be asked to prepare a full statement of cash flow, just a part of it, okay, an extract of it if you like. Now we're going to focus on looking at preparing the full statement of cash flow, and then you can have a go at some examples that are in your notes after these videos, which really focuses on the little sections of the cash flow that you could be asked about in the exam. So, first thing we need to establish is, what is a statement of cash flow? Well, a statement of cash flow is a financial statement, and it provides useful information to the users of the financial statements about a business's ability to generate cash within the year. So we're going to highlight the key areas where a business has spent and generated physical cash. Really, this is just going to show a movement of why opening cash, let's say, was 100,000 and closing cash was only 50,000. So why has there been a change? Why has that cash gone down? Well, the statement of cash flow is going to tell us exactly what's happened in the year. So, the thing we've got to remember with cash flow is that cash is really the key thing to any business's survival. If you don't have cash, you don't have a business. Revenue's great. Profits, they're all right. If you have profits but you don't have enough cash, you ain't going to trade in the future. You need cash to buy goods, which you can then sell and generate more cash in. Profit, it's fine, but it's really misconstrued by various different accounting policies and estimates. Cash balances are a matter of fact. You either have cash or you don't have cash. So there's going to be no estimates, no policies or anything like that in a cash flow statement. It is literally just going to be cash in, cash out. That's it. It's very objective, very matter of fact. Okay. Now, it's important to remember that yes, prior to this chapter we have focused on profit. And as I've already mentioned, cash is equally vital to the success of the business. So if a business has limited cash funds available, they are going to struggle and their going concern may be affected. So, certain advantages then of preparing a statement of cash flow. Okay, well I've already given you some already. As I've already mentioned, cash balances are a matter of fact and are not distorted by accounting policies. Let's think about this. How do you calculate your profit? Well, you do it on an accruals basis if you remember. So as soon as you recognise a sale, you recognise the sales revenue immediately, whether it's a cash sale or a sale on credit. So you could be making lots of sales on credit and selling goods to your customers, and that's going to increase your sales revenue and therefore increase your profit. But then what if you don't recover that money from your customer? Yeah? Well, you'll have high profits but a low cash balance. That's not right, is it? Yes, we can have lots of profits, but if we don't have enough cash, well then we can't continue to trade in the future. So credit sales would be a key example of where profit is distorted by the accruals concept. It's not cash profit that we deal with, it's accrued profit. So the statement of cash flow really aims to eliminate the accruals concept and keep it as a matter of fact. Now there's other judgments and estimates that we use in formulating profit as well that don't affect cash. For example, depreciation, profits or losses on disposal. Depreciation is just a means of estimating the wear and tear of the asset. We do that on an accruals basis. But depreciation has absolutely nothing to do with cash flowing out of the business. It's just an estimate that reduces your profit. So things like depreciation, calculating profits or losses on disposal, credit sales, credit purchases, would all be accounting policies and concepts that would distort profit. Cash flow is cash in and cash out. And what we aim to do with the statement of cash flow is to eliminate those policies and just show matter of fact. And that's really what we're talking about in the second bullet point as well. Cash flow balances are objective. They are a matter of fact. Unlike profit, which is subjective, based on judgments, estimates, the estimate of the useful life of an asset, its residual value, so on and so forth. Okay. Now there'll be lots more estimates and judgments that you'll make as you progress through your financial reporting studies. But depreciation and that sort of thing would be the key estimates where you would have to apply some sort of judgment as a manager of the business. Now, as a result of this then, the users of the financial statements can then establish exactly the cash generation of the business. Where did the business get their money from? Was it from selling goods and receiving money from their customers? Was it because they sold some non-current assets and received some cash proceeds? Or was it because we issued some shares and received some cash, or issued some loan notes and received some cash? You know, how did the business get their cash? But also, how did they spend their cash? Did they spend it on buying goods, paying their payables, paying interest, paying tax, buying new non-current assets, redeeming shares, redeeming loans? Okay, it's very good. We can actually see a breakdown of how the business has generated its cash but also spent it as well. Users can also assess the liquidity of the business. Okay, how quickly a business can turn all of its assets into cash, but also the business's ability to repay debts as they fall due. Okay, do we get enough cash coming in on a regular basis from operating in order to pay our payables within 30 days, but also do we have enough cash to pay off our long-term debts as well? Also, from looking at the statement of cash flow, we can see that loans repaid and received will be clearly shown and notified. And also we can assess management attitude to capital expenditure. Does management invest a lot and then therefore spend a lot of money on non-current assets? Or do they not bother buying non-current assets? We can see that by looking at the cash flow. But finally, we can also see interest payments being highlighted in the cash flow as well, usually in relation to those long-term loans that we've issued or indeed repaid. So, there we have it then. There's lots of good reasons why the statement of cash flow is a very important financial statement. And personally, one of my own favourite financial statements. Very, very useful. It is a matter of fact. It is what it is. Now, ultimately, a statement of cash flow is just a reconciliation between your opening cash balance brought forward and your closing cash balance carry forward. And it's going to show the movements in the year. But what we've got to consider is what exactly we are reconciling. Now, the accounting standard that looks after the statement of cash flow is IAS 7. And IAS 7 says that you should be reconciling not only cash, but also cash equivalents. So let's take a look at them. So, we've got to think about these following definitions when we think about what we're reconciling. We will be reconciling cash and cash equivalents. Cash. Well, that's cash in your hand, but also cash at bank, your demand deposits. Now, that will also include any overdrafts, and that would be a negative cash balance. So cash in hand plus cash at bank or minus a bank overdraft. That's what we deem as cash, and that's what we reconcile. Now, what we also reconcile is cash equivalents. And these are defined as short-term, highly liquid investments that are convertible into known amounts of cash. Okay. Now, we can sell them very quickly. They're short-term. They're highly liquid. We can sell them quickly and receive cash. But also, they'll be very low-risk investments. They won't be risky in terms of changes in value or default. So an example of that would be if we invest in government bonds. Okay, so you walk along to the post office, you want to buy some government bonds in your country's government. It's generally accepted that they are low-risk investments. Okay, maybe it's not so much with what's been happening in the world recently, but usually government bonds or gilts would be a key example of cash equivalent, short-term, highly liquid investments that you can turn into cash very quickly. You can buy them today for £10 and you can sell them tomorrow for that same amount of £10. Very low-risk investments generally. So cash and cash equivalents is what we will be reconciling. Opening cash and cash equivalents to closing cash and cash equivalents. So, what we've done there is introduced IAS 7 and the statement of cash flow and see why it's an important primary financial statement that we need to prepare. In our next video, we'll take a look at actually what the statement of cash flow physically looks like.